Hello and welcome students. In this video, we will discuss about average rate of return, also known as accounting rate of return. So accounting rate of return is basically a formula that is used to calculate the net income expected from an investment or asset compared to the initial cost of investment. Typically, ARR is used to make capital budgeting decisions. For example, if your business needs to decide whether to continue with a particular project, particular investment, whether it's a project or an acquisition, an ARR calculation can help you to determine whether going ahead is the right move, though it is a traditional method of capital budgeting decisions. So in order to calculate ARR, we use the following formula, that is average annual profit after tax divided by average investment. So uh, in order to calculate average investment, we have a formula that is initial investment plus installation charges minus scrap divided by 2 plus working capital plus scrap value. It is important to understand the decision-making criteria. If your average rate of return is greater than your required rate of return or the pre-specified desirable rate of return, you can accept the proposal. Whereas, if your average rate of return or ARR is less than the pre-specified desirable rate of return, then you have to reject the proposal. So here it is a question that ABC Limited is planning to purchase a machine costing rupees 60,000 and having a scrap or a salvage value of rupees 8,000. The economic life of the machine is 5 years and it is likely to give following earnings after tax. So here 5 years are given to us and profit after tax for the individual years are also mentioned. Using ARR method, we need to determine whether ABC Limited should purchase this machine if the company's desirable specified rate of return, or we can say the required rate of return, is 20%. So, in order to solve such questions, first there is a need to write down the critical data. So here the critical data is the number of years given to us. So we will be writing down the number of years, that is from 1 to 5. Also, the profit after taxes given to us, that is 6,000, 7,000, 5,000, 6,000 again, and 8,000 for the fifth year. Here, the other information that is given to us is the cost of the machine that is given to us as 60,000. We can write it down here. And the salvage value is also given to us, that is 8,000 rupees. Okay, and we are also given the required rate of return, that is 20%, or we can write 0.2. So it is given to us, right? So this is the critical data we have been given in the question. So this will help us in understanding the concept better. Now, what we require here is the average annual profits and average investment in order to calculate the ARR. Okay, so here when I talk about annual profit, I mean average annual profit, right? So how to calculate that? So the first thing is you will be calculating average profit. In order to calculate average profit after tax, you can use the formula where you will be summing up all the profit after tax values and divided by the number of years that you are having profit for. So here we can have used the sum function and add all the values and divide it by 5 in order to get the average profit. So this is 6,400 is our average profit. So you can see the formula once again, what we have applied. So sum of all the values from 6,000 to 8,000 and then dividing these values with 5 in order to get the average annual profit after tax. The second thing we require is average investment in order to calculate ARR. And for this, the formula is initial investment. So here in this question, we have 60,000. Installation charges are not given to us. Scrap value is given to us as 8,000. Working capital is not mentioned in the question. And again, scrap value of 8,000 can be used. So here we can easily calculate our average investment with the given information. So average investment will be calculated as is equal to 0.5 because we are dividing by 2 here in the formula. So instead of taking 1 by 2, we are taking 0.5, which means the same into we need to have initial investment, that is the cost of the machine, and minus we need to subtract the salvage value, close the bracket. We don't have any working capital or any other information in the question, or we're not having any installation charges also, so we need to add back our scrap value and enter. So you will be getting 34,000 rupees as your average investment. So this formula can be seen here. 0.5 is for 1 by 2. G18 is 60,000. It is for initial investment. Installation charges are not there, so we have skipped that. Then we have scrap of 8,000. Close the bracket. Plus, we are not having any working capital. We are having a scrap of 8,000 again. So we have added it here. Enter, and we have this value. So in order to calculate ARR, we require two things. That is average annual profit after tax divided by average investment into 100. So we have already got these two information. So is equal to average annual profit divided by average investment will give you the answer. So here it is 18.82% is our answer here. So if you multiply it by 100, you can get it in percentage. And if you want a percentage, you can have it from here also. So here it is 18.82%. Now in this question, if you see, ABC Limited should not buy the machine as ARR of 18.82% is less than the pre-specified required rate of return of 20%. So we should not go for this machine. We should not purchase, ABC Limited should not purchase this machine as it is not a profitable, feasible option based on ARR method of capital budgeting. I hope you understood the question. Thank you so much for watching.